Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, April 6, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And today we had what I'm going to call, at least for the short term, a dead cat bounce. And there's a couple of things going on, and there are some divergences out here. So there is some stuff to talk about, but I do want to go back to yesterday, and yesterday's high and reversal day to me was a cue that this pullback is not really over yet, and there's some more consolidation to be had. And that's why I emphasized yesterday the 232.50 area as what could be the downside objective. You know, it doesn't obviously have to get there, but I think that would necessarily stop the market if it happened within the next couple of days. And so I am expecting a turn from a larger picture perspective around the beginning part of next week that I believe will be the kickoff to the next leg higher in the market. At least that's what the schematic is telling me from this point forward. So, that being the case, I don't think we're necessarily out of the woods on the downside yet, but I think a lot is going to hinge on the phony jobs number that comes out at 8:30 a.m. Eastern Standard Time Friday morning. And what I mean by that is it doesn't really matter, as you know, that I believe, it doesn't really matter what the number is. It just matters the fact that I believe the market will react to the number. Whether it be positive or negative, we can handle it in either direction. It's just I think the market will have a reaction a little bit more than a handful of points based on tomorrow's number, because mainly I don't think we're out of this what I'll call volatility cycle, meaning the corrective phase that began on March 2nd. I'm not necessarily sure that the volatility cycle of that phase is over. I think the low is in, but I don't think the volatility phase is over, and I think that has another few days to go. Based on the fact of yesterday's reversal, gives me somewhat of a clue, and we'll say some more evidence of that. So I won't be surprised at more downside, and I'm not necessarily scared of the downside. I think there's opportunities on the downside if it happens to be for another couple of days, but I do think that whether or not we even go farther, I think that the next phase of the bull market is about to begin. So really over the next couple of days in the bigger picture, it doesn't matter whether we go down a couple of points in the spider or not. Really has little impact on the larger picture for the next, let's say, 6 to 8 weeks for argument's sake. But let's drill down a little bit further into today's activity just for nothing other than a look at just, you know, the pattern that developed today and what we can take away. So today we had a bounce higher. We had a little bit of a downtick in the morning and then a reversal around 10 o'clock, a little bit early. Usually it's around 10:30 or so, but we had a reversal in the morning, and that sent the market higher up into the middle part of the day, and to which point we had a sell-off. But what you're seeing here is a dead cat bounce, a little bit of a consolidation pattern, a bearish consolidation pattern, and now potentially starting another leg lower, not necessarily set in stone, but you can certainly make a case for that. So we had a little bit of a retracement today from yesterday's decline. So from the high of yesterday's decline, not necessarily this high here, but just yesterday's high to today's midday high, you know, or from high to low and then low to high. This is around 50% retracement that came in at around 236. So what I'm saying is that if I just mark off from the high yesterday to today's low, this was about a 50% retracement to midday today. That's a garden variety retracement, normal market behavior. Could have went higher. Maybe we could have gotten up to a 618, and that didn't happen, so we rolled over a little bit. So you can make a case for a number of things. You can make a case for that was all the retracement we're going to get, and we have a negative reaction from the jobs number tomorrow early on, and the market could go down farther, or the market could have a spark higher and we could have a further or deeper retracement tomorrow. Anything is possible. I just wanted to bring a couple of the different looks of the market to the forefront, and I'm going to go back to the daily chart, and then we're going to talk about the IWM, because the IWM today was a divergence on the upside, showing relative strength, being up almost 1% for the day, while the spider was up less than 1/4%. So that has to be viewed, at least in the very short term, as a positive, and it was certainly stronger than the spider. And if you look at the 10-minute chart there, I could have stayed on that before, you can see that we had a nice little surge at the end of the day off a bullish pattern, a different look than the spider. So this could signal continuation, could bring the IWM up to the 200-period moving average tomorrow morning on a positive number and some follow-through by the open. That would be positive for the spider as well. So there's a divergence. So you just want, you want to look at both sides of the market, see what both possibilities are, and if you're an intraday trader, you can be prepared. And if you're not, you can either learn something from this that can certainly be applied to longer-term charts. We know that. So each and every chart we look at can be applied to any time frame. The chart looks the same, or the even different time frames look the same based on the same pattern. And then, of course, you always want to look at the next up or larger time frame that I generally like to look at, which is the hourly. And you see, if we were to go higher in the IWM tomorrow, we would come into a natural area of resistance around 136, which is this red candle high on significant volume in comparison to what we've had over the last several hours. For example, it's an hourly chart. Also, you have the 50-period moving average up here, just slightly higher. That's overhead resistance, some consolidation. So you know that even if we went higher, that would be resistance on an intraday perspective, unless we had a big spark, the market gapped significantly higher, and it was a gap and go, which is a possibility, but that's less of a probability, just a possibility. It's always a possibility. So we'll flip back over to the daily, and we'll go over to the transports. And the transportation average, as we said yesterday even, was showing relative strength, was up almost 0.5% today, 0.4%. But it is putting in a bullish pattern, so it is showing relative strength. This is signaling higher prices are coming, and that is really in accordance with the larger picture once we get past the phony jobs number and maybe the next couple of days, where the volatility could still play a little bit of havoc in the market. But this is certainly signaling higher prices coming. It's a bullish pattern. So I want to take my cue off of the bullish pattern on the daily chart and say, even if we had another couple of down days, it still would be a bullish pattern until and unless we closed below 89.2390 on a daily chart. And I don't see that happening anytime soon in the transports, unless we got a significant downdraft, which obviously could happen, but I don't think that's expected in this index. So that, is another piece to the puzzle that I like to put on the table. It gives me evidence of the bigger picture. I like to say the transports as a leading indicator, whether it be on a shorter long term. I'm looking at this from a longer term perspective. I like to say that's in my bullish camp, so it's on my bullish leading indication camp, or side of the page. Heading over to the gold market. Gold was slightly down today from yesterday's close. The futures show up $5, but down from yesterday's close. So, for example, the GLD was down 44 cents today, or about 1/3%. But it's really nothing of substance one way or the other. It's a bullish pattern, and it's building energy to go higher. And there's just no other way to read this unless, for example, it were to come down significantly, for example, below this pivot low on a daily closing basis, which is 1241.50. So all in all, could go back and forth for another couple of days. could really break out at any point in time from this bullish pattern on the upside. I do not expect a breakdown unless we were to get below 1241.50 on a daily chart closing basis. That would be the most meaningful number out of this pattern here from a longer term perspective. All right, going over to the silver chart. Same routine in silver. It even looks like a more tighter bullish pattern where we have to assume this is going to break higher until proven otherwise, and it would take a break below even this pivot low here at 1802 on a daily closing basis to really break this pattern apart. Could have some backing and filling, but outside of that, it's a bullish pattern and it really wants to challenge this high here. That's the way you have to read this chart. Crude oil today had a nice 1% up day, up 58 cents in crude right now, heading towards the 20-period moving average. It's getting a lift with the market. Not necessarily do the market and crude have to, or do they always trade together, but certainly today the market got a little bit of a lift on a dead cat bounce from yesterday, the waterfall decline, and then crude oil also gets somewhat of a lift, although we did not and we're not able to get above the high from yesterday, and yesterday was a tail candle, doji candle. So we'll see if that holds and we have any more downside in crude, or we just go sideways, or anything goes. There's really nothing to do in crude. It's in the middle of a range, and you know how I feel about the middle of a range. We could certainly see it up at 53, which is a challenge of the red candle high breakdown that occurred. That is really what it wants to do. And if it breaks down, we could have a retrace. There's just nothing to do. There's really no way to read this in any direction or another. I think it's going to be mostly dependent on the market volatility over the next few days. As much as I hate to correlate the markets, that's what I see happening with crude over the next few days at the least. So we'll just leave it at that and take it day by day. Looking over at the bond market, chopping around here and also building energy to get through this 152.23 area. Really wants to get up to 153. So again, came out of this bullish pattern, is just having another kind of relapse, building some more energy to go higher again. No damage done. Tested some lows this morning and then rebounded. So a positive close. It's always how they close them, not how they open them in any of the markets. And there's really nothing negative here to say about the bond market. It is in a bullish position. The moving averages are nicely uptrending. So this is pretty much a tightly wound bullish pattern that does want to go higher. So whether we get an imminent rise in bond prices, may that mean a decline in stock prices? It is possible. That does happen quite frequently, where money will flow into the bond market as the equities have downward pressure. We'll see if that holds true over the next couple of days. But right now, bonds look to be in a bullish position. Going over to the dollar. The dollar is moving higher out of this bullish pattern that developed over the last few days. I thought we would need a few more days. We did put in a tail candle. This may just be a retracement. Tomorrow will tell the tale. Most likely if it was a retracement or not, that is possible. If this is a tail and going to hold for a few days, we would likely see this retracement pull back, and then we would have some kind of a more meaningful retracement if this is going to move higher, or potentially this whole entire down leg is not finished, where I expected the dollar to come all the way down in the 97 area at minimum of the 200-period moving average. But since we did come close to the 200, if we did head down in that direction again, I don't think the 200 would hold. I think we would come down closer to my original target of 97 or slightly below that. We'll see. The jury's still out, and we'll see what happens. Whether this tail holds or not is going to be a big tell for me. If it doesn't, on the upside, we'll make a challenge for this red candle high first. But we'll take it one day at a time. And with that, it's everything I wanted to discuss tonight, so I'm going to leave it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.